China is pulling in the reins on its economy. One leverage using is to increase the reserves banks have to keep at its central bank by 0.5%. Diane Swonk, the chief economist at Mesirow Financial, is an advisor to the Federal Reserve and the reserve banks. She recently completed her second term on the Congressional Budget Office's panel of economic advisors, and she joins us live. Diane, welcome back to Bloomberg. Always good to have you on.
Good to be here.
Diane, I guess the first place to start is, do you think that China's doing enough?
No. I mean, that's the easy answer. Of course they're not doing enough, otherwise inflation wouldn't be so out of control. And the bottom line is it sort of underscores how really the flaws that China has in not having a more market-oriented currency, but that's only one piece of it. They've got to also stimulate their own domestic demand so they can become more self-sustaining. They can't rely on the rest of the world. They're just too big to expect the rest of the world to support them now. Being the second largest economy in the world, but one of the poorest, is a very difficult position for China to be in.
Diane, we broached that question, or Sarah Eisen did, when she interviewed Philly Fed Bank President Charles Plosser in Washington yesterday. I want to play some of what Mr. Plosser said, and then we'll get your reaction.
But it is fair to say that China does have an inflation problem, and that's been creeping up on them, and they're going to have to eventually take actions to either allow their exchange rate to appreciate more or to control inflation, which would be the opposite of that. So it's, you know, they've got a challenge.
Diane, would you agree with that assessment?
Absolutely. Charlie's hit the nail on the head. Is they're probably going to have to allow their exchange rate to appreciate. And part of the thing is that they don't want to do it looking like they're doing it in response to criticisms by the U.S., but they're going to have to do it for their own internal reasons. And that's why it's going to be done ultimately. I think you're going to see a combination of an appreciation in their currency and some reining in of their own bank credit. But at the end of the day, they've got to start really relooking at their economy. We've got our own warts in the U.S. We've got our own flaws. Bernanke laid out we need to be a more investment-oriented, export-oriented economy, but implicitly that says we're just not going to be the atlas holding up the rest of the world, most notably China, forever. And
speaking of Chairman Bernanke, he was in Frankfurt, Germany today, and he did take a shot at China. He criticized their weak currency policy. Was that fair?
I think it's more than fair at this stage of the game. I mean, this is something, you know, it's the elephant in the room. The reality is it was unusual for the Fed chairman to do that, but let's face it, after the pummeling the Fed chairman took from the G20, I'm surprised he was as restrained as he was. And whatever you think of QE2, and there are legitimate risks out there, the way these children were acting at the G20, I'm a mom, I wanted to give them all time out.
Can we assume then that the next move in China is inevitably going to be on rates?
There will be another additional probably 2 to 3 rate moves before the end of the year, but I think we're also going to see a movement on the currency, and that's going to be very important. The question is how much. They have to move gradually to deal with the vested interests that they've got, and I mean vested by their political interests in export-oriented industries where they've got some political money being made in those areas. This is the same thing with lobbyists here in the U.S.
How strong are the concerns in China about food inflation?
Those have got to be huge concerns. One of China's biggest issues is that, remember, it was a lot of inflation that led to the Tiananmen Square incident. The Chinese public are more than willing to tolerate their government the way it is as long as their middle class keeps growing and people keep getting improvements in their standard of living. When you start eroding that and people can't be fed, you get a lot of backlash, and that's a lot of people to try to control, and that's something that China wants to avoid at all costs.
Is China going through this, through the banks, to try to avoid a bubble at this point?
They're trying to avoid a bubble. They already have some bubbles over there. I mean, avoiding or dampening a bubble that's already there. They certainly need to do more sooner and faster so that they don't have to pay the consequences. We already know in the U.S. the consequences of a bigger bubble bursting are much worse than stopping it sooner along the way.
All right, Diane Swonk, chief economist, Mesirow Financial, joining us live today. Diane, always good to have you on. Thanks so much.
Thank you.